Good afternoon. Will staff please confirm quorum?
President Meister.
Here.
I took mine from last time.
Director Fritz.
Here.
Director Windig.
Present.
Director Altamirano.
Hello.
Yes.
You're supposed to keep
We
your
have
notes for PIA. That's why I'm taking notes. Just letting you know.
Really? You?
Check it out.
A quorum being present, the August 6, 2026 meeting of Strategic Housing Finance Corporation Board of Directors is hereby called to order at 1:33. We will now move on to agenda item 2, public forum and citizen communication. Do we have any registered speakers?
I do not.
All right, hearing none, citizen communication is now closed. We will now move to the director's report. I recognize Executive Director Diana Gray for the director's report.
Excellent. Welcome, everyone. Thank you for being here. Your agenda does indicate financial report, and you may recall that we have moved to a quarterly cadence. While those financial reports are complete, F&A has not had a chance to review those with staff, so that full report will be delayed until next month. However, there's summary slides in your board package. I want to call your attention to a few upcoming events. We tentatively expect to have an appointee named for the empty board seat on August 20th. We shall see. And then there are a few upcoming conferences that you are welcome to attend with strategic staff. As always, reach out to Jenny if you have an interest. And then wanting to give early reminder of our scheduled fall briefing date with the Commissioners Court, one of the 2 times in the year when the court asks their appointees to come and spend some time with them. In the realm of reminders, happy to announce that the board SharePoint site is now up. We sent you a link in the last bulletin. It is still in beta. Please be gentle. But we are hoping to continue to build that and improve it over time. Another note is that we sent in one of the recent bulletins a video of a staff presentation on build-to-rent model. You may recall that we didn't have time to do that at one of our other board meetings. And so we were asked to send that along, starring one Gloria Nguyen. And we may have a deal coming before you in the next months, so it may be worth reviewing. That concludes the director's report.
Great. Do any board members have any questions for Director Gray? Thank you for the report. We'll now move on to item 4, the consent agenda. The consent agenda consists of the following items: approval of minutes from the July 2nd, 2026 regular meeting. Are there any requests from directors to remove an item from the consent agenda for separate consideration? Hearing no objections, the consent agenda is approved. At this time, the board may enter executive session pursuant to the applicable provisions of the Texas Government Code. The executive session agenda includes consultation with legal counsel regarding litigation to Texas Lakeway Apartments, Texas Creekview Austin, Austin Colorado Creek Apartments, and Texas Austin Manor. Is there a motion to enter executive session? Director Prince, is there a second? Director Altamirano, all those in favor say aye.
Aye.
Aye. All those opposed, no. The motion carries. Those not participating in executive session may now leave the room.
Yes.
I'm
so sorry, President Huddleston, for the record, noting that
yes, Director Groves has joined at 1:36.
Indeed.
Board is now back in open session. There is no action to be taken as a result of the executive session. We now move to voting items. I recognize Executive Director Gray and Development Analyst Gloria Nguyen to proceed with the staff presentation.
Excellent. Board members, we are presenting for your consideration a Memorandum of Understanding with DMA Companies. Janine Cisak is here with us today. Turn it over to Gloria.
Yes, so hi everyone. I'm here with Janine and we'll be quickly going over the agenda item for Arbor Park MOU, and at the end of the presentations we are happy to take any questions that the board members may have for staff and the developer. And so quickly we will now go over the project profile. And so Arbor Park, it represents an exciting opportunities for Strategic to acquire a newly constructed 9% 55 plus senior community located at 6306 McNeil Drive in the Northwest Austin area. And the property is currently owned by Austin McNeil DMA Housing, which is a limited liability company affiliate created by DMA companies. And they're seeking a proposed partnership with Strategic to benefit from property tax exempt status. And this will be our first time partnering with DMA. And I also want to quickly highlight how this is a truly unique deal for us, since Arbor Park is an operating property currently in lease out, and so opposed to a new development projects that we typically presented to the board, and even more so as a 9% deal, which we rarely get a chance to come across, as they typically do not meet the property tax exemptions. And so to answer what prompted the request today, the deal was originally underwritten in 2021, and so that's when pricing and expenses were much higher due to COVID-related supply and labor conditions that drastically delayed constructions. And after roughly 3 years of work, construction on the property is completed in 2024, and they were placed in service in January 2025. And at present, Arbor Park now includes 147 total units, comprising of 1 bedroom and 2 bedroom floor plans. The developer for Arbor Park is DMA Development Company, which is also part of DMA Companies. And DMA Companies, they are a mission-driven Austin-based firm established in 1999 with a proven track record in the multifamily and especially the senior community space. And the firm is founded and led by Diana McNeil, a leading figure in Texas affordable housing. She's backed by 40 years of experience, and she's also currently on the executive committee of the Housing Advisory Group, as well as serving as the board treasurer for Housing Work Austin. And to date, the firm has developed 34 affordable communities, it's totaling over 3,000 units, and majority of them are located in Texas. They also have a really strong presence here in the local market with ownership and management across 8 different affordable communities in Austin, and those are totaling a little over 15,000 units here in Austin. And the firm also operates through 3 integrated service lines, including advisory, property management, and development. And Arbor Park is currently managed by DMA Properties, which is the in-house management affiliate. And through the in-house management, they effectively lower the operational risk and also provide DMA with the direct day-to-day oversight of lease up execution and long-term performance of the property. And we all know that this oversight is really important for a property like Arbor Park, where hitting stabilizations on schedule can greatly impact the deal's economics. And in this slide, we just have a quick snapshot of what the proposed ownership structure is. And at closing, Strategic would take over as the managing member, and DMA would still remain in the partnership as the administrative member, with DMA Properties continuing as the property manager. And aside from DMA, the project has received tax credit equity investment from NEF assignment corporations. They are an Illinois not-for-profit corporations, and they will also be remaining in the partnership as the investor member. And in this slide, we have an overview of where our current portfolio sits and how it is concentrated today. And looking at the map, we can see that Arbor Park is in the Northwest Austin US 183 corridor, which is a area or submarket where we have yet to expand our presence. And with the additions of the property to our portfolio, would meaningfully diversify our portfolio by introducing a newly built senior asset in a high income and high opportunity submarket that is currently outside the organization's geographic footprint. Here in this slide, we have a map of what the surrounding area and the neighborhood looks like. And Arbor Park is located in the Millwood and Bancroft Woods neighborhood. The property is well positioned to serve elderly residents seeking accessible, amenity-rich housing in a stable suburban settings, and the resident, they can conveniently access daily essentials. And on the map, we can see that there's within 4.4 miles away from the property, there's an HB grocery store alongside multiple urgent care clinics and primary care offices that are within 1 or 2 mile radius from the property. And residents can also benefit from the proximity to many different retail and dining options at the Palmer McNeil intersection. Public transit is readily available via the Cap Metro 383 route along the US 183 corridor that is adjacent to the property. And this will allow the resident to be connected to regional destinations such as the Domain and the Arboretum. And the area is primarily auto-oriented. However, there is a fixed road transit along Research Boulevard, and there's also a no-cost shuttle program that the property offers to enhance mobility options for the current residents. Okay, and here in this slide, I wanted to provide some relevant demographic data to really help us answer the questions whether there is demand for senior affordable housing in Austin and where that demand is heading. And so we look on the chart on the left, it is tracking the projected growth for the 55 plus populations in the Travis County, indexed to a 2026 base of roughly 314,000 residents. And between 2026 and 2035, that cohort is expected to grow by roughly 33%, or about 104,000 residents. And this is driven by the Austin in-migrations as well as the increasing number of current residents that are aging into that group. And on the right table, it is showing the income distributions for 65 plus household in Travis County. And reading the table, we can see that roughly 27% of those households are at or below 30% AMI, and 52% at or below 60% AMI, which aligns directly with Arbor Park unit mix as well as the income band it served. And so put simply, the property is positioned to serve more than half of Travis County 65 plus household, and that figure does not yet account for the resident age 55 through 64 who are also qualified to live at the property. And now I'm turning over to the bedroom and affordability mix. We can see that 76% of the total units are one bedroom, and they average around 700 square feet per unit, and the remaining 24% are two bedroom that average a little over 1,000 square feet per unit. And as a 9% deal, Arbor Park offers genuine affordability, and we can see that here in the table on the right. And most of the units are set at 60 and 50% AMI, which account for 108 units or 74% of the total units. The property also include 12 units reserved for household at 30% AMI, as well as 13 units at 120% AMI. And so this make up to about 90% or 133 total affordable units, while the remaining 10% will be offered at market rate. And here we have a snapshot of what's the current leasing trend at the property. And since the first occupancy report that we received from DMA back in May, leasing has moved steadily in the right directions. And as of July 27, the property is approximately 80% occupied, and the majority of the remaining vacancy sits in their one-bedroom units that are at 60% AMI. And based on the current leasing trends as represented here in the table, the property is tracking to reach 90 to 95% occupancy by October to meet the target stabilization timing and satisfy the minimum occupancy requirements for the perm loan conversions, also targeting in November. In this slide, I have a snapshot of how the property tax exemption is the core driver for this proposed partnership and how it supports the long-term operations of the property. And a quick note on the terminology. So the debt coverage ratios here is basically measuring the net operating income against the annual debt payments. So in other words, how many dollars of cash flow the property generates for every dollar of debt payment. And so a 1.2 DCR would mean that the property produced 20% more cash flow that it needs to cover the debt service. And so anything below a 1 means that the property does not generate enough income to pay its debt, and that is something that no lender can support. And we can see in both tables, with the tax exemption in place, we can see that the resulting NOI uplift allowed the property to generate enough cash flow to support the annual debt payments, while without a tax exemption, we can see that they are not generating enough income in order to make the annual debt service, and resulting in DCR of 0.89. Here we have a summary of the current capital stack. The developer has received a $13 million perm loan commitment from Impact Capital. The capital stack also includes roughly $4.2 million of supported soft loans from the City Road Program and the TDHCA Housing Trust Fund. And both of these soft loans are structured at 0% interest rate. And so they are also payable at maturity or at sales and refi, and neither of which will burden near-term debt coverage ratio for the property. And to date, the DMA has invested approximately $4.9 million into the project, primarily in the form of construction interest carry. And there's also approximately $2.6 million in developer fee that's available for distributions between DMA and Strategic. Next, so in this slide we have the current project timeline, and we are optimistic that the property will be able to reach stabilizations in October this year based on what we've seen from the recent reports. And following the board approval of the MOU today, staff will work with the developer to submit the ownership transfer application to TDHDA, and that is required for strategic admissions into the new ownership structure. And we estimate that it may take up to at least 2 months for TDHDA to finish their review of applications as well as to approve it. And so we are estimating to complete this by October to allow for the anticipated closing and as well as the permanent conversions in November of this year. So Arbor Park, the property is expected to produce 7,064 in total AIM score, which contribute roughly 60% towards the 2026 target AIM of 11,125. And as the board may recall that we already surpassed the 2026 target AIM with the 3 most recent transactions that was presented to the board last month, all of which have received MOU approval. And so the projected AIM score here is what we are projecting for 2026, including Arbor Park. And that would equals roughly 3.8 times the 2026 target score. Here we have a summary of the MOU deal terms, and as I mentioned at the start of the presentations, this is a pretty unique deal for us. So a lot of these terms are slightly different from what we have on our website and for our our bonds deals. And we can see here the ground lease is calculated based on 10% of the property's most recent tax bill, and we have that in hand because the property is already operating. And the acquisition fee is based on the year 1 ground lease payment, and future payments on the ground lease will be on January 1st of each year. Strategic is also entitled to receive 25% of the total developer fee, which will be split pro rata with DMA share, and payments will be from available net cash flow. And we also have here the incentive company management fees, which sits below the developer fee in the waterfall. And as noted in the payment terms, the fee is non-cumulative and will only be payable after all deferred developer fee has been fully repaid. And I will go into more details on that in the next slide. And finally, the existing LURA for the property only has 120 income restricted units, and so that would equate to roughly 82% of total units, which does not quite meet our requirements of at least 90% total units must be income restricted. And so to comply with this requirement, the property will convert 13 of its 27 current unrestricted units into affordable at closing. And in this slide, we have a summary of the projected fee and revenue to strategic over the next 15 years. We have the total amount as well as the NPV. And regarding the incentive company management fee, the reason we projected it to be 0 is because the developer fee sits above it in the waterfall. It's also at the 11 positions on the waterfall, and the developer fee, we expect it to absorb 100% of the residual cash flow throughout the 15 years whole period. And so we are essentially treating the developer fee as our effective net cash flow. And that incentive management fee will only become live once all of the developer fees has been paid off, and which we don't expect it to be fully paid off until the end of year 15. All right, and so now I will walk through what's the process at Arbor Park and what are some of the mission criteria that Arbor Park checked off. And so the project has already completed pre-screening and a formal application review. They also have been presented to REC and received approval to negotiate MOU. We have the draft MOU and related partnership documents finalized, and they are ready for your considerations today. And on missions, Arbor Park is in an ideal locations that offers easy access to various neighborhood amenities, daily essential as well as public transit. Moreover, the properties offers geographic footprint for our organizations by expanding our presence into the Northwest Austin submarket, which help diversify our portfolio with inclusions of 30 and 50% AMI units. And lastly, we have the recommended board actions for this agenda item. First, staff recommends that the board authorize executions of a memorandum of understanding as well as related partnership docs to help facilitate strategic participations in Arbor Park. Staff also recommends that the board authorize the formations of 3 Texas limited liability companies, each wholly owned by the corporations. And lastly, we recommend approval to proceed with drafting all related partnership documents in alignment with the terms we have in the proposed MOU. And that concludes my presentations for Arbor Park. We are now open and happy to take any questions from board members, we have our staff, and the developer.
Thank you, Gloria. We will now consider voting item 5A. This item is a resolution to authorize the authorization of an MOU between the corporation and DMA Development Companies, LLC, regarding the acquisition of Arbor Park, authorizes the formation of affiliated limited liability companies, and includes related provisions. Is there a motion? Director Winnick. Thank you. Is there a second? Director Prince. The floor is now open for questions or discussion. Does anyone have any questions? Any questions? Would you like to speak about the project?
Yeah, thank you. I don't know, well, I guess it's a small room. I don't need to speak into the mic. Just want to thank staff for processing our application, asking really good, thoughtful questions, actually underwriting the deal, which is something a lot of the HFCs don't necessarily do. I'm not sure, but I love when our partners understand the deal. It really it's the right thing to do, and it makes for a better partnership. So I really appreciate staff's work on that front. But just speaking to one of Gloria's slides and something that she and I were discussing in that back conference room while we were waiting for y'all to finish executive session, DMA is probably the premier senior housing, affordable housing provider in the city of Austin, and we are seeing not only at Arbor Park but at our other senior communities that while the tax credit rents are rising and the median income in Travis County is rising, it's not rising for seniors on fixed incomes. So we've got long wait lists, we've got vacancies coupled with long wait lists of people who cannot afford a 60% tax credit rent. So this tax exemption allows DMA to be more flexible. We're actually going through our wait lists. After today, we'll be able to go through our wait lists and just work with people on basically, what can you pay? What can you pay without being rent burdened, instead of having to, have everybody pay 60% rents, which in Austin is $1,340. Which for many seniors on fixed income does not sound affordable, does not feel affordable, is truly not affordable. So this tax exemption is really important for us to be able to serve area seniors, and we appreciate your partnership and look forward to our first, I can't believe it's our first DMA strategic deal. I've known Diana for, at least 20 plus years. So we used to be neighbors back in the day. So we appreciate y'all and staff, and I am still happy to answer questions.
I also failed to mention that you are talking to the 2026 TAP Jean McDonald Lifetime Achievement Award recipients.
Thank you. Yeah,
It's really important important to her that we mention
Yes.
that.
I like that. I've been telling people I'm the Doogie Howser of affordable housing because I'm only 28. So the fact that I won a lifetime achievement award.
No, her 24
I watched
years.
that show, just so you know. 'Cause I think for some folks it's like, what? But I watched it. Wanda.
Okay.
Yeah.
Well, thank you, Diana, for that recognition.
Thank you for coming today. It really matters.
Of course, your offices are so nice, and they smell like new office smell. So it was a pleasure to come up here and meet y'all. Thank you for your service to Travis County.
Thank you so much. Does anyone have any questions, comments?
Maybe just a quick comment. Just really appreciate this project. So excited to see this deep level of affordability. It really stood out to me, Christina, when you shared the demographic trends. And not only that, but the distribution of what those folks are going to be able to afford. And what I noticed was that what you're providing exceeds what those demographic trends are to serve that low and income population of our 55 plus seniors. So that's great. I love the geographic diversity. Love the partner. Partnership is so important to us. So I'm excited about the project and the partnership.
Any further questions, comments?
It looks like a real nice place. My daughter used to live over there. I used to pass by and I've seen the commercials. And I'm actually old enough to move in there.
There you go.
Send your friends.
Anything further? Discussion is closed. We will now proceed to a vote. All those in favor, please say aye. Aye. All those opposed, no. The motion carries.
Thank you. Thanks to Gloria for doing the heavy lifting. I'm very interested in your next two items, but I'll have to debrief later because I've got a next appointment. But thank you. It's nice seeing you all.
Excellent.
All right. Thanks.
Thank you, Gloria.
All right. Bye.
Well, but the combined, right? Like combined under 60. It is, but that's what's also
Terms.
Yes. While President Huddleston is considering her next introduction,
Oh, yes.
I will mention that we are a little behind schedule, and so I am encouraging staff to exercise your powers of concision when presenting, and then taking questions at the end.
See you next time.
Yes.
All right.
We will now consider voting items 5B and 5C, both pertain to revisions of our transaction terms. Recognize Jackson for his presentation.
Yes. Good afternoon. Try to keep it short and sweet, still thorough. So yeah, I'll be walking us through our recommended term sheet revisions for this year. Generally, we like to update our terms once or twice a year, stay current with market conditions and any legislative changes. You should have the revised term sheets in the board book, so I'm just going to walk us through the largest changes. Nothing too major this time around. At a high level, I'll start with the 4% bond term sheet first. Just are proposing some revisions to the existing fees. We've added a bond application legal retainer fee and added some tenant protection language to our term sheet as well. The largest change I'll explain first here is a revision to our ground leased fee on our 4% LIHTC term sheet. So ground lease is based off of tax abatements for each year. And last year we updated our term sheets. We wanted to include an ongoing ground lease fee for LIHTC deals to match our workforce structure. Historically, we've based that fee on the value of projected annual property tax, taking 10% of that annual value each year, and that annual tax being calculated for the projected taxable value. For workforce deals, we've underwritten that taxable value at 80% of total development cost. This past year, we received some pushback from some of our LIHTC developers, arguing that because there's less rental revenue from a fully affordable deal compared to that of a deal with market rate, then value should be based off of NOI rather than the cost of construction, which is apparently how the appraisal district values these assets. So TCAD publishes a cap rate for tax-exempt low-income housing properties as of January 2026 that is 6%, looked at a couple of our light tech prospects and applied this projected NOI in a year of stabilization, and we found that it leads to a slightly lower property tax value on average compared to the 80% method. So to compensate for this, we've increased the share from 10% to 15%, and this results in a very similar initial ground lease amount. So there is no significant impact to revenue projections, but we're doing this just to align our term sheet with developer expectations for underwriting. Okay, I promise the next ones will be a little bit quicker. We've also just, in an effort to eliminate potential confusion and start negotiations a little bit further along with what Strategic would prefer, we've added some preferences and requirements for our waterfall and the cash flow distribution. So we would prefer that ground lease be paid first out of remaining cash flow, and we are requiring that deferred developer fee be paid either first or second, just to make sure that some of these deals that are deferring a high amount of developer fee, that those get paid off in time. And so, yes, we also added the bond application legal retainer. So our counsel requires a $5,000 retainer fee at the time of application as a courtesy to our developer partners. We're just letting them know up front. And one small tweak to our bond issuance fee. We are now requiring that the first 3 years of annual issuance fees are paid at close rather than 2. This is, first of all, to align more with industry standards, and also this does align kind of with the longer lease-up periods that we are seeing at our property. So this way deals don't have to pay bond fees while the rental income is still really low. Also, just a note, this would apply to our standard deals, of course, but also as well as our short-term or any bond issuer-only deals. Okay, I'm not going to run through all of these here today, but here is a list of the tenant protections that we've added to our bond term sheet. As a reminder, this past year we passed additional tenant protections for any future projects that Strategic is going to partner on, and so by adding them to the term sheets, we're just intending to kind of spell these out up front for developer partners. And in this chart, you can see how Strategic's tenant protections meet and or exceed requirements under the LIHTC program or state statute. So there's another high-level look at revisions to the LIHTC bond term sheet. And quickly run through the workforce housing term sheet as well. At a high level, we have made some tweaks to our affordability set-asides, and coinciding with that, some tweaks to our public benefit analysis, also our bonus point structure, and we've added our HB 21 underwriting requirement to our term sheet. So starting with the affordability set-aside requirement, just for context, since HB 21 was passed, Strategic has been asking for affordability beyond what's been required by that bill. This has created kind of 2 tiers of requirements. There's been the 50% HB 21 test and then the 60% Strategic HFC test, and that's been a little bit confusing for developers. So our proposed solution is that we still want to have affordability beyond what's required, but we just want to simplify it a little bit. And so we are tweaking the set-aside requirement from 10% to 15%. That's a unit share of units that are basically affordable to those earning 50% or less of area median income. So 10% share is what it currently is. We're increasing that to 15%. And the part that should be simplifying it for developers is we're just doing away with the 60% requirement and just bringing that in alignment with what's required by statute to 50%. And this should eliminate confusion for everyone involved in the transaction, so the developer, the third-party underwriter, and also staff. Our hope is that while we're dropping this 60% rent reduction for simplicity's sake, we would still achieve that level due to the increased set-aside requirement from 10% to 15% of those 50% AMI units. And at the bottom here, we also made a small tweak to the bonus point structure. So the lease addendum, that's now just a general standard baseline requirement for our deals. So we've eliminated that as a bonus point, and we've moved those 2 bonus points from the lease addendum to our public sector workers preference. That now being worth 4 points, so still 10 bonus points available in total. And then the last addition is, just adding this to our term sheet, the HB 21 underwriting requirements, so just letting prospective partners know about this up front, that we will need to obtain a report that demonstrates that this project will meet that 50% test in the first 3 years of operations. And then lastly, similar to the LIHTC term sheet, we've also added our list of these new tenant protections. And we show how they meet or exceed state statute. So in conclusion, staff is recommending approval of these revised term sheets. We are happy to answer any questions y'all might have at this time.
Great. The chair will now entertain a motion on agenda item 5B, revisions to the 4% LIHTC and bond issuer development terms. Is there a motion? Director Groves. Thank you. Is there a second? Director Winnig. It has been moved and seconded that the board approve voting item 5C. The motion before us is to approve the resolution as presented. I will now open the floor for questions. Does anyone? Yes, Director
Just a
Winnig.
super quick question. I know you compared on the tenant protections to requirements, legal requirements, but I think you also are part of a roundtable, and that we've been trying to match particularly the tenant protections terms with a subset of that roundtable. How's that going?
I thought you were Jim, you're not. So we continue to work on that. In fact, I think that, I'm sorry, David. Psych. I think AHFC has recently updated their terms, so it's ongoing.
Would you say it's moving in the direction of a uniform approach?
I would say progress has been slightly slower than we would like.
Yeah.
I think we are perhaps looking at more of a snowball approach where we work with our partners who are closest to us, right? In terms of what we agree on, get some parity there.
It's Jim poking his head.
Oh!
It was so cute. He was just
I heard
being-
my name.
None of the partners have outright said they're not doing.
Okay, that's all
Yes.
I wanted to know.
It's
Thank you.
just how they want to get
I
there.
appreciate that. No other question.
Madam President, point of order. We're on B or C?
B.
B, okay. B. I misheard you saying C. We're good. We're on B.
We're on B.
We're on B, right, Ms.
4% LIHTC bond issuer development terms. Any further questions? Jim is now here. Let's see. All right, I will now open the floor for discussion. Does anyone want to discuss anything about the 4% long-term sheet revisions? No, just hearing none. Discussion is closed. We will now proceed to a vote. All those in favor, please say aye.
Aye.
All those opposed, no. The motion carries. The chair will now entertain a motion on agenda item 5C, revisions to workforce housing development terms. Is there a motion? Director Winnig, is there a second? Director Elderman. The motion before us is to approve the resolution as presented. I will now open the floor for questions. Any directors have any questions? Hearing no further questions, I will now open the floor for discussion. Anyone have any discussion points? No. Hearing none, the discussion is closed. We will now proceed to a vote. All those in favor, please say aye.
Aye.
All those opposed, no. The motion carries.
Thank you, Mr. Lee.
Very concise, very concise.
We will now move on to the discussion item. This item is a presentation regarding the preliminary fiscal year 2027 review revenue projections. I will now recognize Deputy Director David Dinoff and Director of Finance and Administration Katie Adams to introduce the presentation.
Clicker's down there.
Okay, thank you. All right, good afternoon. So before we dive into the revenue projections we have, I just want to give you some context on how to, considerations for these. So we used the same similar process as last year, but we had some improvements due to AI assistance. As you may recall from a past board meeting on the housing market data report, we expect 2027 market-wise to be similar, but maybe some slight improvement to 2026. So the assumption we use is that our current portfolio performance would be a good indicator of how we will perform next year. We were very conservative in these projections. We've discounted revenue sources line by line, project by project, depending on our understanding of where things may or may not land. For example, some pipeline projects may not close. They may hit in a different year, maybe Q1 of 2028 or Q4 of 2026. And then also we made some discounts to our investment income based on timing uncertainty with HPF deployment that we anticipate next year. And so the final number that you're going to see is almost 2/3 less of what was the total universe of potential revenue that we projected for next year. When it comes to the AI assistance, this was not just someone going to ChatGPT and saying project my revenue and then going home and calling it done. It was an iterative process over weeks, months, included hundreds of prompts across the project to really get the model to produce accurate and work we were confident in. Lots of human vetting of this. Our 24 properties have nearly 24 different cash flow waterfalls. And to understand those cash flow waterfalls and how the money will eventually, if it does, reach strategic HFC, we have to go into the documents. And that is the work that our analysts did last year. It was very time-intensive process. This year, we were able to have the LLM, the large language model, your Claude, review those documents much faster than humans can, understand the cash flow waterfalls, and then build out, based on different information we had fed it, what their expectation would be for fiscal year 2027. And so some of the documents that we provided it were the deal documents, 2025 audits of those properties, and then also the most recent financial performance data we had in the trailing 12s at the time of the projections. And I will let Katie handle. Or actually, do I have anything else? Yeah, I do want to say a few more things, I'm sorry. And so we did build instructions and template prompts for consistency across staff, so everyone was using the same prompts and the same types of documents were fed to the AI. And then we also had a rigorous quality control process to confirm that formulas were right, the model was functioning correctly, and just vetting the AI inputs themselves. This was good for us to see that it validated our last year's manual methodology because there were no surprises and things looked similar to what they did, just with improvement and a little bit higher degree of confidence. And this can be carried over to future years, what we built this year, and so that will cut down substantially on staff time spent on those projections. And now I will hand it over to Katie.
One thing that I do also want to note about our revenue projections is just sort of something that it's becoming more relevant for us. And so I just want to make sure we're including it as part of the conversation. Revenue projections, the way that we do them right now, are essentially a cash basis projection. And so that means the revenue projection numbers we're going to show today are representative of actual funds we anticipate receiving in 2027. as we kind of layer this into budget development, we do not do a cash basis budget. We do something called an accrual basis budget. Sometimes they'll start to diverge a little bit. And so we're building out some systems kind of in the background that we hope help tell that story a little bit better. But since they are still in development, sometimes we'll see a little bit of confusion between the different processes. So just wanting to state that clearly kind of at the top, revenue projections kind of on a cash basis, overall budget when they get fit in will be slightly different. We are watching both and I hope to be able to kind of tell that story a little bit better as we progress. Here we are in revenue projections. So this slide shows sort of what David mentioned about the discount process of each category. So you'll see the as scheduled according to what we believe that we are owed per the deal documents. The as scheduled also does take into account market conditions, so it's a little bit lower than just what strategic might be owed. It shows the discount that we've applied across each category and then the budget input. So you can see that we are moving down from over 13 million of possible revenue to about 4.6. This is also just to help anchor a little bit. This is the 2027 revenue projections alongside the 2026 budget, just to show sort of differences there. You'll see that kind of one of the big drivers of differences in revenue projection is going to be that first line there, developer fee. The reason for that increase, which is almost double from this year's budget, is a couple of different things. I think the biggest driver there is when we're assessing what's likely to be paid out in any given year. In 2026, we had a couple things we thought were going to come in developer fee. They didn't. So those same properties have kind of been rolled over into 2027. The probability is higher because we already know it didn't pan out. We expected it last year. Yeah. And so much higher probability in 2027. You'll also see an increase in pipeline projections. Pipeline projections is sort of where we put deals that maybe haven't closed yet, prospects, things like that. And we have a couple more for 2027, which is really nice. And so there is a pretty solid increase there as well. Most other categories are similar to last year. Breakout is shown there. Something fun that I'm trying out are different ways to sort of discuss our revenue categories. I know it's a lot to look at those big charts with all of our account code names. And so one of the categorizations that I think might be valuable to us is going to be a breakout sort of operating fees. I wish I had changed the legend of this ever so slightly. Operating fees, which would include milestone developer fees and portfolio operations. We break out milestone fees because it's part of our portfolio operations category, but it's such a large chunk of it. I think it's valuable to be aware of the split. But sort of looking at that between those portfolio fees, the pipeline fees, which are prospects, and then interest income, which is just sort of what accrues on bank accounts and investment accounts. So we can see here, about 60-ish, 70-ish% of the revenue projection is associated with current portfolio. 23-ish% is prospects, and then that remaining 8 is interest income. Great. That is the last slide. I'm just going back to this one. I think it might be a good place to hold discussion.
Thank you, Katie. All right. Any questions, comments from the board? Reminder, no voting on this item. It is just discussion. Questions?
I would just say comments.
Yes.
I appreciate the layout of the operations versus pipeline. I think that's really helpful to see that distribution. So how much are we relying on new projects versus existing portfolio? And then maybe in the futures, like runoff of existing portfolio, things like that. But great job, thank you.
I'm so glad you say that because every year I'm like, two takeaways, and I wish the new board member was here. We must transact, or we make life really hard for a future board. We must grow our portfolio size. Scale supports our ability to survive since we don't have revenue, and so different ways of achieving scale are helpful. And the upside in budgeting of if we are not conservative is now we can fund HPF and portfolio fund, which before we would do the transfer, wacky things would happen. Now we have really clear strategic direction about what we would do. But I think one of the things that I always take away at this part of the year is like it would be so helpful to have a bit more scale in terms of the baseline for quality that we need, FTE wise and spending wise, is sort of not negotiable. And I think so many of the challenges that we discussed today are, some would theorize are because we underinvested, even though we had revenue in the FTEs that we needed, and so it's sort of something that always comes across when we look at our revenue distribution, and it gets hidden as we go through the year. But I hope that we will keep reminding the new directors and future generations of these are our economics and why we need to tend to them so that we can invest in the people that allow us to do things that are concerned with the quality level.
Anything further from any other directors? I have one question on sales and refinance distribution. You've got it at $4 million, and the discount's $95. What deals or how many deals are one? Okay,
Cambridge.
Understood. All right, thank you. Anything further? Yes.
We talked about that in committee a little bit.
We sure did.
Do you want to just tell the director here what you said to the committee that was helpful on that point about why it's entered as 200,000?
And so the 95% discount, yes, is kind of what we talked about. It's one property, and so the question is, will it hit or won't it hit? One thing that we talked about in committee is for that reason, might it make more sense to sort of call it zero? I think because several of the other categories are discounted, we want to, be recognizing it in some way. And so it might not be that the 200,000 falls in that line. It probably is an all or nothing, but sort of as a way to acknowledge it within the budget and speak to an amount that we expect to see represented somewhere.
Great.
Anything further? Great. At this time, thank you, Katie. Thank you, David. Diana.
So 4.6 is our
These, you may see, maybe not on this, these are our preliminary revenue projections.
It's our cash
We
basis.
will, yes, cash basis.
Let's get all our caveats.
We may consider we may continue to refine. I am not hearing a lot of objections or concerns from you, and we'll continue to vet. We are tentatively scheduled to present our proposed budget to you next month, which will have both revenue and expense. And so we will finalize that by then. I don't anticipate huge changes. It's exciting to see it be better than it was last year. We live in volatile times, but we are feeling better. As Director Adams mentioned, part of this is because we had some significant developer fee that, may not hit this year. We're waiting to, see.
Great.
Thank you, staff. At this time, the board may enter executive session pursuant to applicable provisions of Texas Government Code. The executive session agenda includes executive director mid-year performance review, personnel matters. Is there a motion to enter executive session? Director Groves. Is there a second? Director Winnick. All those in favor say aye.
Aye.
All those opposed say no. Motion carries. Those not participating in executive session may now leave the room. Executive session is adjourned at 4 o'clock. The board is now back into open session. There are no actions to be taken as a result of executive session, and there is no further business before the board. The meeting is adjourned at 4:01. Is there a motion to adjourn? So moved. Director Groves, is there a second? Director Prince? All those in favor say aye. Aye. All those opposed, no. The motion carries. The meeting is adjourned at 4:01.
Yay, thank you.